Hello, ladies and gentlemen. I welcome you to this our second segment where we are going to concentrate basically on three uh, capital investment appraisal techniques: the net present value approach, the internal rate of return, as well as the payback period. So, um, we're going to start with the net present value, okay? And this approach uses present values as a way of appraising a project. Okay, so we'll be looking at the cash flows to see if when we match the cash outflows versus the cash inflows, we should have a, a present figure. I mean, a positive figure by the end of the day. So this present figure is called the net present value. Okay, the ultimate present or negative figure is going to be considered as the net present value. However, for management to accept a project, it should have an NPV which is greater than zero or a positive NPV. If by the end of the day we have got a negative NPV, then we have to reject the project, or we should not venture into that particular project, or we must not buy a particular machine or invest in whatever building that has been offered. Okay, so that's the basic. So let us do this example and see where we can get. Martins is considering an investment in new machinery which would cost 25,000 and would um, produce additional cash inflows of in year 1 8,000, year 2 15,000, in year 3 10,000. The machinery would cost could be sold for 2,000 at time 3. Is the project worthwhile if the discount rate is 8%? So our discount rate is 8%, and when this discount rate is going to be applied the way we did when we were looking at the present values in our first video. Okay, the present value computation, you can use tables, you can use your calculator, it doesn't matter. Okay, so it is better to be systematic, so you can just come up with a present value table where your first column should be the time. Okay, first column should be the time, and you must have another column for the cash flows. Okay, the cash flows, and the amounts. Okay, the amounts in dollars, and then we need the discount column. Okay, we must have the discount uh, column, discount factor at, we are told that it's 8%, and then we have got the PV, the present values. Okay, present values are the amounts which result when we multiply cash flows by discount factors. So the time is in years. Okay, in year 0, today, year 0 simply means today. Okay, so today we have got 25,000 to invest. Okay, so this is the initial investment. Is the machinery will cost 25,000, so our initial investment is 25,000. This is a cash outflow because we want to pay the machine for the machine. Okay, and then in year 1 we have got the inflow. Okay, we have got the inflow or income. So this is the income in year 1, that is 8,000. Year 2, income again. Okay, specifically, it is called um, additional income or incremental income. Okay, incremental or additional income. Then in year 3, you've got income of 10,000. Then the discount factor, sometimes looking at the tables might be um, time consuming, and you can just do this. You can calculate this using the formula 1 over 1 plus r to the power n, as we have did in the previous um, video. So 1 over 1 plus r, our r is 8%, so 8% is 0.8. Okay, 0.08, okay, to the power n. Okay, in year 0, okay, in year 0 you can see that it will be 1. Okay, so if you punch this figure, you can see that 1 over in bracket 1.08 to the power 0. To the power 0 simply means the answer is always going to be 1. Whether it's 1000 to the power 0 or 1 million to the power 0, the answer is going to be 1. Okay, that's the mathematical law, and we are not here to prove why it is so. That's not part of our remit. Okay, so 1 over 1 is equal to 1. So this is why I put 1 in year 0. The discount factor for year 0 is 1, and you can see here when you punch those figures in your calculator, you must get a 1. Then for year 1 now, let us now determine the discount factor for year 1. We can use tables, or can also use our calculator to see what is going on. So if you punch this figure in your calculator, 1 over 1.08 to the power 1, you must get 0.926. 0.926. Alright, so that's 0.926. Okay, and we need to finish up all the figures to see if we can rush with the time. So we just have to punch the figures in our calculator, and here you must get your 0.857. Okay, 0.857. You need also to get here, that's here now for the third year. You just have to change this, put a 3 here to the power 3, and you must get your 0.794. Okay, but now I want you to see here, we are told in year 3 the machine can be sold for 2000. All right, so you can as well have added a 2000 on this 10,000 in year 3, or you can also just have a portion for the scrap. The scrap value for this machine is 2000. Okay, this is again in year 3, so we are going to use the same discount factor because it's in year 3. Okay, so this is why I said you could have just added the 2000 to the 10,000 and get a 12,000 there, and you multiply it by 0.794. So let us now multiply these discount factors with the cash flows. So obviously in year 0, the 25,000 negative is going to come as it is. And then here, 8,000 multiplied by 0.926, we must get 7,408. Here we must get 15,000 multiplied by 0.857. We must get 12,000. That's 12,855. Okay, and the 10,000 multiplied by 0.794 794, that's 7940. And then this one should be 1.588. Then we have to add them up, and we should, that's minus 25,000 plus 7,408 plus 12,855 plus 7,940 plus 1,588, and we get our 4,791. So this is our NPV. That's the net present value, and you can see that it is positive. So we should accept the project. So okay, the project is worthwhile, we should accept it. Okay, so you also have to acquaint yourself with this template. Okay, you have to acquaint yourself with this template. All right, so whenever you're confronted with NPV problems, you need to remember this template. Okay, you just have to have an NPV, a PV table. This one is the PV table template. This is the template for the NPV, which is a PV table, rather. So you can see that the first row is the headers. As you can see, these ones are the years, right? And these are the descriptions of the cash flows. Okay, cash flow description. All right, and these ones are the years. Year 0, year 1, year 2, year 3, year 4. Then the sales receipts. Okay, the income we can get. Okay, these are the income. And then the cost which can be incurred. Okay, cost of sales, and so forth. These ones, they are negative, the outflows. And then we get this one. Then when we deduct costs from sales, we get this some form of profit. And then this is the initial investment, as we have seen there in our previous example. Okay, the initial investment is always negative. Okay, and these are the profits we have calculated above. And then this is the discount factor, and when you multiply the discount factor with this initial, these cash flows, then you have to get the present value. Okay, this information is presented in a transposed manner, a bit different from how we did in our computation, but just the same. You can just follow. So the NPV now is the sum of present value. Okay, the sum of present value. Now, this word sum, simply consider that you appreciate that the initial investment is considered as well, but although it will be in a negative way, in a negative form, but it is added to the other PV. Remember, it is also in a PV. This one, as you can see in our previous example, the negative 25,000 is a PV on its own, although it is negative, but it is a PV. Then it is added to other cash flows which are positive there, and the resultant will be the NPV. Okay, I'm sure you are not confused there. Now, you need to observe certain things when you are computing your NPV. Okay, you must always and only use the relevant cash flows. When you are saying relevant cash flows, these are incremental cash flows. Okay, which are applicable to a project. Okay, so cash flows are what you need. So look at income before depreciation. All right, then reapportionment of existing fixed costs is relevant. It is irrelevant. Okay, we did about the reapportionment of fixed costs and so forth in our previous lectures. Okay, and normally fixed costs are irrelevant. Okay, in other words, fixed costs are irrelevant. sunk costs or past costs, the costs which have already been incurred are irrelevant. Okay, you need also to include dividend payments, but you have to include the effect of tax allowances and working capital requirements. These ones have to be included when you are doing your uh, NPV computation. Then opportunity costs are relevant. Opportunity costs are relevant. For example, i.e. cash flows gone because of a decision. Let's say if we are going to buy a machine, or we are going to dispose of a machine, all right. But that machine was bringing us something, was bringing us money, or was bringing us profit, or was bringing us some contribution in the way we are doing business. If we dispose of it, we are going to lose. Okay, we are going to lose that contribution we were getting. So the amount we lost, or the contribution we have lost, is an opportunity cost. So whenever we are doing our NPV analysis, we have to put the opportunity cost, or the contribution loss, as a relevant cash flow. It is part of cost which has to be considered. Then ignore all interest and other finance flows. These are taken account by the discount factor. So the discount factor takes into account the interest charges, the returns expected by the shareholders, and so forth. The discount factor takes care of that. So do not worry about the interest again in your computation. Now, let's talk of the internal rate of return. The IRR method calculates the rate of return at which the NPV is zero. To calculate IRR, the following steps are taken or are essential. Number one, calculate the net present value using the rate for cost of capital, which is a whole number, may give NPV close to zero. This particular rate we have used. Okay, sometimes you're not given this cost of capital. You just have to pick any figure, which is a whole number, and compute your NPV. Then, if the NPV which you have calculated is positive, use the second rate greater than the first rate. Okay, so that, remember, you need to achieve you need to compute another NPV which is negative to make your working a bit easier. If the first NPV is negative, use the second rate less than the first rate. Then use two NPV values to calculate IRR using the following formula. IRR is equal to lower percentage plus net, the NPV of the lower percentage, okay, plus the NPV of the lower percentage, all divided by the NPV of the lower percentage minus the NPV of the higher percentage, close bracket, multiplied by higher percentage minus lower percentage. Okay, you understand this as we do an example. Now, the NPV of an investment at 15% is 50,000, and at 20% is 10,000. The internal rate of return of this investment, the nearest whole number, is, in this case, although in our formula we had said that you just have to use NPVs which are one positive and the other negative. In this case, we are given all positive NPVs, but you mustn't be lost because of that. Okay, you mustn't get lost because of that. So we know that IRR is equal to lower percentage, okay, plus bracket NPV of the lower percentage, all divided by NPVL minus NPV high of the higher percentage, okay, multiplied by high minus low, high percentage minus lower percentage. So we then have to say the lower percentage, in this case, the lower percentage is the 16, because there is 5,000 minus 10,000 multiplied by uh, the difference between the higher and the lower, that is 20% minus 15%, which is 4%. Okay, and we get 16% plus. If you punch your figures very well, you can see that you get 5%, and the result is 21%. And our answer is C. Okay. Now, the above interpolation method is useful for cash flows extending over 1 year. If the investment is just for a year, we may make use of the PV formula itself. Okay. For example, if 500 is invested today and generates 600 in 1 year's time, the internal rate of return can be calculated as the PV of cost is equal to PV of benefit. All right. So the cost was 500, so the amount we invested this year. Okay, and then we are going to get 600. Okay, the PV of benefit, all divided by 1 plus R, and we just make R subject to the formula, and we get our 20%, as you can see there. All right, this applies when we are just appraising an investment that is going to be taken within a year, in 1 year, but not extended over that period. Okay, we can also estimate the IRR by using interpolation, the graphical method. Okay, the graphical approach. Okay, where we need to just plot all the relevant NPVs, okay, in a graph, and when, for example, we are given a project is NPV, there's the following NPV. Okay, so NPV is at various percentages. If the cost of capital is 5%, the NPV is 5.3. So you can see on the graph on the right side, you can see that the NPV of 5.3 is this one, and then at discount rate of 10%, the NPV becomes 400. So you can see this is the NPV, and then at 15%, the higher, you can see that the higher the discount rate, the lower the NPV. All right, the higher the discount rate, the lower the NPV. So you can see that at 15%, the NPV is negative and is far much lower at the higher percentage of 20%. Okay, so the IRR can be estimated as the rate which crosses this horizontal axis. Okay, where it crosses that's our IRR, because that's where the NPV will be 0. Remember, this is the NPV line, so this is the 0 line. Okay, so IRR is the rate at which NPV is 0, and you can see that when the NPV is 0, IRR is somewhere less, 11% or so. Okay, that is that. So which method is better, NPV or IRR? Okay, NPV is similar to calculate, that's the advantage. All right, whereas IRR can be more easily understood. NPV is better for ranking mutually exclusive projects. Okay, mutually exclusive projects are those projects which cannot be undertaken at once. So either you do project A and not project B. So in that situation, the NPV is the best way to go. All right. NPV is easy to incorporate different discount rates. So when you're using the NPV, it's much easier. Now, IRR can be confused with accounting rate of return. Okay, and it ignores relative size of investment, maybe several IRR, there may be several IRRs if cash flows not conventional. So here we are simply saying that if we are having a situation where in year one we've got a positive cash inflow and then year two a negative, those are non-conventional cash flows, and in that situation the IRR may be misleading. Okay, um, now let's discuss about the payback period. Okay, I think we have exhausted a little bit here. Uh, okay, I had forgotten a very important point to make on why on the decision rule related to these two methods. Okay, um, an investment can only um, be accepted. Okay, if we are using the IRR method, accept investment um, with an NPV positive at a discount, right, lower than the IRR. Okay, so in other words, we are simply saying if the IRR is greater, if IRR is greater than cost of capital, then the project can be accepted as, as automatically they will give uh, they'll give a positive NPV. Okay, but the shortcoming is that um, when the projects are mutually exclusive, then we have to use the NPV rule, because uh, here we'll be saying we do not want a project just because it gives us a positive NPV, but we can only take a project that gives us a higher NPV. Okay, remember the IRR is a discount rate that gives an NPV which is equal to zero. Okay, so um, if the the cost of capital or the discount rate is lower than the IRR, obviously the NPV is going to be positive. Okay, so if the cost of capital is uh, lower than the IRR, we are going to have a positive NPV. Okay, so which means every project we are going to undertake is likely to, it will be giving us a positive NPV. Okay, so the NPV is more informative. All right, it's more informative and gives us a better ranking of mutually exclusive projects. All right. That being said, let us talk of the payback period. I mean, the payback technique. Payback is the time taken for cash inflows from a capital investment project to equal the cash outflows, usually expressed in years. It is used as a minimum target or first screening method. Okay, it is not in itself conclusive or final. All right. So if there are two, I mean, there are two ways in which the payback technique can be used. All right. In the first instance, we'll be having uh, two mutual exclusive projects. Okay, and in this case, we need to accept a project that has got a shortest payback period. Okay, if there are two or more mutually exclusive, then we need to pick that project that has got the shortest payback period. Then, um, if management of a company has a payback period limit, then only projects with payback periods which are less than this limit would be considered for investment. In this case, uh, even if the project can be undertaken at once, we can only undertake those projects which are going to give us a payback period which is less than our target payback limit. Okay, that is the deal. Now, let us do this particular example to see if we can make some sense out of this whole uh, narration. A company is considering a project to purchase an item of equipment costing 900,000. This will be depreciated over 6 years uh, to a residual value of zero. So at the end of the period, this particular equipment is going to have a zero residual value. Okay, so the scrap value is going to be zero. Now, the expected additional profit from using the equipment in each of the 6 years would be 40,000 given there, 80,000, 100,000, 150,000, 100,000, and in year 6, 40,000. What is the expected payback period, assuming that cash flows accrue at an even rate during each year? So in this case, we simply have to uh, construct another column here for the cumulative cash flow. Okay, cumulative cash flow. So right, let me try. Okay, so remember we've got our year zero on top, year zero, uh, where we have to consider the investment 900,000. Okay, the 900,000. So in year zero, obviously our cumulative, let's try to look for eraser. Okay, all right. So we are saying cumulative cash flow. All right. So in year zero, we have got 900,000. Start with that one. And then in year one, now cumulative simply means that we have to add. So this 900 plus 40,000, that's negative 900 plus 40,000. We are going to have a negative. Uh, we are going to have a negative 840. Okay, okay. I'm sorry. There's been some mix-up of figures, and to adjust this question. Okay, so for that, okay, let us read again company is considering a project to purchase an item of equipment costing 900,000. This would be depreciated over 6 years to a residual value of zero using the straight line method. The expected additional profit from using the equipment in each of the 6 years would be, so we are having this, then we are required to calculate the expected payback period. Okay, given that the cash flows accrue evenly throughout the year. So as I have indicated, you just have to know that there is year zero. Okay, year zero is the initial investment of 900,000. Okay, and you just have to have a column for the cumulative cash flows. Cumulative cash flows. So in year zero, if you start with year zero, it is 900,000 negative, and then if you add 190,000 to this negative 900, we are left with a negative 710,000. We add in year two, okay, we add year two. Remember, this one was in, okay, my table here, is it clear? I think to confuse you guys, let me try to write this information because my column here is confusing. Okay, this should be in line with year zero, and this one is in year one. Okay, all right, this one is year one. Then year two, if we add this negative 700 plus 230, we must arrive at 480. Let me negative one. Let me try to say minus 710 plus 230. That's negative 480. This is year two. Okay, this is in line with year two. Then if we then add 250, that is in year three, we end up at 230. Okay, 230. This is year three, and then if we add the 304, we end up having a positive figure. End up having a positive figure. Okay, and what's the positive figure? 230 plus 230 minus 230,000 plus 300,000, we get 70,000 is year four. Okay, so you can see that our payback period from this should be 3 years. Okay, the year where we last saw the negative cumulative figure, so that's 3 years. So it should be 3 years plus plus now the fraction. Remember, the fraction now should be 30. The fraction should be 230 over 230 over the 300,000. Is 300,000. Okay, which is in year 4. Okay, that will give us positive 70. Okay, so this should be the denominator, and this should be the numerator. So 230 over to 30 over 300. This should be 0.7666 years. And to convert this into month, it will be multiplied by 12. Multiply by 12, you get the number of months. So it will be 3 years plus years. So 3 years plus multiply by 12, that's 9 months. This is 9.2 months. So the answer should be 3 years, 9 months. Okay, and the answer should be answer should be D. Answer should be D. Okay. That's our answer. Okay, my board is playing here. Okay, doesn't matter, but as you can see, there is a D there, and that D is 3 years, 9 months. I'm sure you have seen that. Okay, my board is having. Okay, but sometimes this here we didn't consider the time value of money. So discount, I mean, the payback period technique can be discounted as we did in the NPV. So you can use the discounted cash flow techniques in payback period to consider the time value of money. So as you can see in this particular example, um, the cash flows have been discounted. These are the cash flows, okay, and we have to discount them at the discount rate of 10%. And you can see that we have got the present value, as you can see here, and the NPV of this investment was 31,000, which was positive. However, using the discount, the payback technique, we have to come up with the cumulative NPV. Okay, so in this case, you can see that the first in year 0 it was negative 100,000. Then if we add this positive present value, we get this negative 72. And we add this one, we get this one. If we add this one, we get that one. Okay, so as you can see here, um, our payback period should be in year this is year 3, right? Sorry, the year 3, this one, because it is the year. Okay, what's happening with my pen? Um, okay, um, this is the year. Alright, so this is the year when we last saw a negative figure. That's the year we pick. Okay, so the payback period should be 3 years plus 1390. Okay, 1390 plus this other, over 20490. Yes, okay, and we have to get, let me try, 1390 over 20490. That's 0.067. Okay, so this is equal to 3 years many months? That's 0.067. So that's multiply by 12. Okay, multiply by 12. That's 0.81. So 0.81 months, almost about nearly 1 month. So this is about 3 years, 1 month, about 1 month. So this means that the payback period was actually um, 3 years, 1 month. Okay, you can see here. Okay, okay, that's it. Alright, so just forget about this. Right, payback period should be yes, 1 month. Okay, so I'm hoping that you have been helped, and when you feel you need more coaching, please don't hesitate to contact me. I'll always be there for you, and it's been a wonderful experience, you know, taking you through this interesting paper. All right. So one point I want to emphasize is that the figures of the payback period means nothing unless we know uh, the company policy in terms of the payback limit. Payback period limit. Uh, they say the company here in this case would undertake the project if they have got a payback limit of say 3 years, okay, or 4 years. So if this payback period is lower than 4 years, then the company might decide to undertake the project. But if the if let's say the payback period limit was 3 years, you can see that this project has exceeded the 3 years, therefore it cannot be accepted. Or let's say another project which was being evaluated was having a payback period of 5 years. So obviously this period, this project would be having a shorter payback period and would be accepted. So that's how you can come up with the decision using the payback period technique. I hope you have been helped, ladies and gentlemen. Once again, I say I'm very pleased to be your tutor. If you find anything, if you find the reason to need or to want to be coached further, then don't hesitate to contact me. I'll always be there for you. These are my credentials, these are my contact. You can email me at that email address, or get in touch with me on these numbers. As you can see on your right side, those are my numbers. Anytime, any day. You can also check these numbers on the advertising video that follows. Okay, don't forget to subscribe, to share the video with your friends.